Good morning. My name is Miguel Gonzalez, and I'm a retirement specialist with over 19 years of experience helping clients in retirement income planning, overseeing investment of funds, and designing retirement plans. Let's talk about the non-investment pitfalls investors face. Experience has taught us that successful investing requires discipline and patience. A long-term investment focus can help when emotions run high. While balancing ongoing changes can seem daunting, a steady course can help buffer you against turbulence and uncertainty. To help you overcome these challenges, I've compiled a list of common mistakes and guidelines. Mistake number one, believing investing is a smooth ride. Even though the stock markets have performed very well overall, investors need to remember that nothing lasts forever. The dot-com bubble of the 1990s and the Great Recession of the 2000s remind us that eventually high markets will fall. However, investors may still find opportunities to grow their money in a choppy market. To help you stay ahead of the market developments, preparing for declines is essential. The desire to pull out of the markets when they tumble can trump long-term goals. Instead of retreating during turbulence, you may need to adjust your investment mix. By remaining flexible, you may take advantage of opportunities to act on underpriced assets, manage risk, and increase return potential. Active portfolio management enables you to make these types of investment moves. But before you act, a good first step is to create the strategies that will guide your investment decisions. Retreating and starting over each time can make it difficult to catch up. Mistake number two, trying to time the market. When markets rally or pull back, seeking out the top to sell or the bottom to buy may seem tempting. The problem, however, is that investors usually guess wrong, potentially missing out on the best market plays. For example, between 1986 and 2005, the S&P 500's annual compound rate was 11.9%, even while weathering Black Monday, the dot-com, 9/11, and more. Over that period, $10,000 invested in 1986 would have grown to more than $94,000, excluding investment fees and expenses. The average investor's return during that period, however, was just 3.9%, meaning that same $10,000 grew to slightly more than $21,000. Why? One reason is that you're trying to time the market. When people invest on the highs and pull out on the low, they miss opportunities by not remaining patient. The problem is that equity gains can often be made in a very short amount of time. If you're not in the stock when it moves, you may miss out on the whole play. The bottom line, accurately chasing the market's top and bottom is virtually impossible. No one can do it consistently. A better approach may be on small adjustments to help you stay the course. The S&P 500 is an unmanaged index which cannot be invested into directly. Past performance is no guarantee of future results. Mistake number three, taking too much risk. Not timing the markets is one thing. Another mistake is having too much risk in your portfolio. Risk involves the chance that the investment you choose will perform differently than you anticipate. During the bull markets of the mid-1990s and early 2000s, money poured into equities, often into risky tech and internet stocks. The value stocks trading low had many of their investors fleeing toward higher returns. When the bear market followed in 9/11, the bottom fell out of the tech sector. Meanwhile, many value stocks weathered the storm. Investors who took on too much risk, not wanting to miss out on the dot-com boom, most likely saw their portfolios take a severe beating. Portfolio risk can be insidious. Holding a diverse mix of stocks, bonds, and alternatives may seem adequate for managing risk, but it's just one component. If you correlate these investments, meaning they move in similar patterns, then you can jeopardize your portfolio. If your investments respond to market declines all in the same way, you may increase the risk of losing all your money. The objective is to take on the amount of risk that is aligned with your long-term goals. When evaluating your portfolio, ask yourself these questions. Are you too heavily invested in one asset class, sector, or geographical region? Do you hold too many alternative investments? Do you hold many of the same investments or overlap too much? Is your portfolio correctly structured for your long-term goals, investment horizon, and appetite for risk? Mistake number 4, taking on too little risk. Playing the market cautiously and taking on too little risk may also negatively affect your portfolio. While minimum risk can feel like a safe move, you can miss important market rallies. During periods of market turbulence, many investors tend to flock to low-risk investments like U.S. Treasuries and cash. This aversion to risk can affect long-term investments, as too many fixed-rate investments put a cap on your portfolio's profitability. Inflation is a serious concern in long-term investing, and too little growth in your investments can leave you with a shortfall in your retirement years. Even in both 2016 and 2017, investors pulled billions of dollars out of U.S. stocks, the largest amount since 2004, despite the S&P 500 experiencing record highs. And a variety of factors may be causing investors to act more cautiously, including ongoing global uncertainties and fear from market highs. By trying to reduce portfolio losses, however, investors may be trading one type of risk for others: inflation, high valuation, greater than expected volatility. While equities can have greater loss potential in short-term fixed-rate investments, they also can have a greater potential for gain. For many investors, hunkering down only in safe haven investments, ones that retain value during market turbulence, is a luxury but not realistic. With inflation eating away at cash every year, most investors need at least some growth-oriented investments. To know whether you should take on more risk, consult with your investment representative. Ask yourself the following questions in regards to risk. Do I have enough growth-oriented investments in my portfolio? Can I afford to take short-term losses for long-term gains? Could I afford to live on Social Security or other income in the event my accounts decline in value? How comfortable do I feel taking on more risk to potentially achieve higher investment returns? Could I live on my investments without taking on additional risk? Mistake number 5, making emotional investment decisions. When markets swing, emotional decision making can wreak havoc on the most carefully designed investment strategies. A large number of investors lost money in the mortgage meltdown of 2008. Many crashed out near the bottom, fearing that the markets themselves were collapsing. But even as markets rally, some investors still aren't taking on enough risk and have their money sitting on the sidelines. The memories of the crash run deep. Generation X investors born between 1965 and 1981 have experienced many market falls, making them more susceptible to emotional investment decisions. Some investors may even still make emotional decisions when working with a professional. According to one study, 57% of investors who work with investment representatives still panic and sell during down markets. Fear and greed can easily drive our financial decisions. Fear can cause us to abandon an investment strategy when the outcome is not what we want. Greed can cause us to chase investment fads and take on too much risk. As you invest, you can support your long-term strategies by avoiding these emotionally based decisions. As investment representatives, we can serve as the voice of reason when emotions run high. When markets decline, remember, we can help answer questions, provide reassurance, and show you the opportunities that volatile markets may provide. Mistake number 6, failing to diversify. Warren Buffett once said that diversification is protection against ignorance. In other words, one can know everything about an investment or predict the future. The first part of the diversification strategy consists of mixing asset classes by holding various stocks, bonds, and cash. You could also include alternative investments like real estate that match your goals and investment profile. By diversifying, you can avoid investing aggressively into one class. If your investments weigh heavily in one area during a market rise or fall, the dynamics could devastate your portfolio. The second part of a properly diversified portfolio is mixing within asset classes. One critical mistake many working investors make is holding too much of their employer's stock, which can be a recipe for calamity. Imagine that you lost your job and access to your company stock. You could lose your retirement savings in one fell swoop. Some experts recommend capping them, capping your company's stock at 10%. To help overcome this, opt into a good mix of small cap, large cap, international, and sector diverse equities. Now, this is the disclosures. While a market decline may affect a certain stock or sector, or a gain in another might offset the loss, neither diversification nor asset reallocation can ensure a profit or protect against a loss. There's no guarantee that a diversified portfolio will enhance your overall returns or outperform a non-diversified portfolio. Alternative investments may not be suitable for all investors and should be considered as an investment for the risk capital portion of the investor's portfolio. The strategies employed in the management of alternative investments may accelerate the velocity of potential losses. Investing in small cap companies may involve greater risk in price volatility and potential reward than investing in larger, more established companies. International investing presents certain risks not associated with investing solely in the United States. These include currency fluctuations, political risk, accounting procedure differences, and the lesser degree of public information required to be provided by non-US companies. Let's go on to mistake number 7. More on returns than managing risk. Many investors make a big error by chasing performance. Buying an investment due to its past performance is not a reliable way to predict future winners. We hear this all the time. Popular growth stocks in the 90s experienced great returns before they suddenly went south, taking many investors' portfolios with them. In short, if a particular asset class continually outperforms for 3 or 4 years, you can know one thing with certainty. You should have invested 3 or 4 years ago. Often, by the time the average investor decides to invest, experienced investors have already rebalanced. Meanwhile, the not-so-savvy money continues to pour in beyond the investment's prime. Don't make this mistake. Stick to your strategy, rebalance, and focus on investments with great fundamentals rather than chasing returns. Mistake number 8, ignoring the impact of taxes. When reviewing investments, one key rule to keep in mind is that you should always look at the after-tax return on investment. At first glance, a 5% return beats a 3% return any day of the week. However, if that 5% return was from a taxable stock dividend and the 3% came from tax-free municipal bonds, then the situation changes. An example, hypothetical $10,000 investment might be worth $17,908 after 10 years at a 6% annual return. However, accounting for the hypothetical state and federal taxes of 5% and 25% respectively, you would only take home $11,228. These taxes push your annual return down to 1.2%. Ignoring taxes never pays. This example is hypothetical purposes only. It's not intended to portray past or future investment performance of any specific investment. Your own investment may perform better or worse than this example. You should consider the impact of taxes whenever you buy or sell investments. Develop a financial strategy. Discuss your estate or philanthropic plans. Give gifts. Remember that the federal government taxes investment income like dividends, interest, and rent on real estate, as well as capital gains. Thus, it's critical to efficiently structure your investments to help minimize how much money you lose to taxes. To minimize tax obligation, one investment strategy is to shift a portion of the investments to assets that generate income exempt from federal governments, such as municipal bonds. And while this approach may not work for everyone, it reflects how forward-looking strategies can help you thoughtfully structure your portfolio. If you are concerned about taxes, be sure to discuss these items with your investment representative and tax professionals. They can work with you to determine which options are right for you. Note, this is the disclaimer. While taxes are not something to overlook, sound investment strategies focus on one's investment goals, appetite for risk, and time horizon. Municipal bonds are subject to availability and change in price. They're subject to market and interest rate risk if sold prior to maturity. Bond values will decline as interest rates rise. Interest income may be subject to alternative minimum tax. Municipal bonds are federally tax-free, but other state and local taxes may apply. And the last mistake, number 9, that investors make, avoiding professional advice. Being unaware of your own mistakes can lead you down a detrimental investment experience. For example, in studies, gauging people's feelings about whether they are better than the average person at a task, about 90% of respondents will believe that they are. In reality, the vast majority of people can't all be better than average, meaning many people are not self-aware. And the same thing applies to people who choose to invest by themselves. As such, having someone there, like myself, to help you make sound, logical investment decisions can help you overcome your own irrational perspectives. In fact, Americans are unsure how to even prepare for retirement. 74% of people surveyed agree they need more retirement preparation, but only 40% know how to do it. But professional guidance can help. People who work with a financial representative report more confidence in their ability to reach retirement goals. Successful long-term investing requires the ability to position and rebalance your portfolio to ride bear and bull markets. This level of complexity can make working with an investment representative critical to your ability to meet your goals. Chasing returns and following a cookie-cutter approach on your own is risky. We believe at Cortburg Retirement Advisors that successfully navigating the turbulent investment world of today requires training, prudent management, and commitment to long-term active investment strategy. In conclusion, investors who recognize and avoid these 9 common pitfalls may give themselves an advantage in pursuing investment goals. A long-term investment outlook requires a personalized strategy that accounts for your current and future needs, investment time horizon, and appetite for risk. These factors help ensure that no matter how the markets perform in the short term, your investments can be positioned to work towards your long-term goals. Along the way, sticking to your strategies and not letting emotions get the best of you may be essential. While it is impossible to predict which directions the markets will go, generally each downside contains an upside potential somewhere else. With discipline and focus, you can strategically turn your dreams into financial realities. Above all, investment representatives, they can help apply their expertise to help you pursue your goals so you can relax and enjoy life. If you have any questions about the information included in this video, or would like more information about the services and experience we provide, please contact us at 212-776-4094. We're happy to meet with you to help build the financial life that you desire. Once again, this is Miguel Gonzalez with Cortburg Retirement Advisors. Please take a moment to click the like icon, and don't forget to also subscribe to my YouTube channel to receive our weekly video podcast every Monday morning. Thank you for watching, and I will see you all next week.